If you're buying a home or even just own one in Los Angeles, you've probably had a bit of sticker shock lately. And I'm not talking about the home price. I'm talking about homeowners insurance. It's quickly turning into one of the biggest and, frankly, most unexpected costs of living here. So let's just get right into it. The big question on everyone's mind is why? Why is LA home insurance suddenly so ridiculously expensive? Well, we're going to unpack all the reasons, and I think some of them are going to surprise you. And first off, no, you're not imagining things. The numbers are just staggering. I mean, we're talking annual premiums anywhere from $2 to $3.5 grand for a home in a flat area. But if you live on a hillside, that can easily jump to over $6,500. And for people who have to use the FAIR plan, you're looking at $7,000 or even more. This is the new reality of owning a home in LA. So how in the world did we get here? Well, it really boils down to 4 key drivers, 4 big reasons for these soaring costs. Let's break them down one by one. Okay, first up, insurers now look at California and they don't see a fire season anymore. They see a year-round threat. They're pricing in the constant risk of not just wildfires, but also high winds and even the mudslides that happen after a fire. So even if your specific house has never had a single claim, if you're anywhere near hills or a lot of vegetation, your rates are almost guaranteed to go up. Number 2, and this is something a lot of people don't realize, your insurance isn't based on what your home is worth on the market. It's based on what it would cost to rebuild it from the ground up. And in LA, with the insane costs for labor, materials, and just getting the permits, every time that rebuild estimate goes up, your premium goes right up with it. The third reason is, well, it's just basic supply and demand. You've got a lot of the big household name insurance carriers who are either pulling out of high-risk areas completely or they're just not writing new policies. So with way less competition, the companies that are left can pretty much charge more. And spoiler alert, they are. And finally, to top it all off, the actual rules of the game have changed. New regulations in California now let insurance companies use these forward-looking, predictive wildfire models. It also lets them pass on more of their own costs directly to you. Now, the idea was to keep these companies from leaving the state altogether, but the side effect for us homeowners is we're seeing bigger and faster rate hikes than ever before. So with all these things happening, a lot of homeowners, especially in those high-risk areas, are finding themselves forced onto something called the FAIR plan. But what exactly is it, and is it really a solution? Let's take a closer look. So the FAIR plan is basically California's insurance of last resort. It's a state-mandated program that offers very basic coverage. But here's the massive catch. It only covers damage from fire and smoke. That's it, nothing else. And because the FAIR plan is so limited, you have to get a second, separate policy. They call it a companion policy to cover everything else you need, like theft, liability if someone gets hurt on your property, or water damage. It's the combined cost of these 2 policies together that leads to those huge premiums we were looking at earlier. Okay, so what if you're trying to buy a home right now? How are you supposed to deal with all this during the already crazy stressful escrow process? Well, think of this next part as your survival guide. All right, listen up, because this is probably the single most critical piece of advice I can give you. Start shopping for insurance the second your offer is accepted. I mean it. Your lender will not fund your loan without proof of insurance. Waiting until the last minute is a surefire way to delay your closing or even kill the entire deal. Now, you're probably going to hear your insurance broker talk about the 80% rule. It sounds complicated, but it's pretty simple. It just means you have to insure your home for at least 80% of what it would cost to replace it. If you don't, the insurance company can actually penalize you and reduce your payout on a claim, even for just partial damage. Let's just walk through a quick example to see how this works. Let's say the total rebuild cost for your home isn't even $1 million. But to try and save some money on the premium, you only insure it for $600,000. That's only 60% of the rebuild cost, way below that 80% rule we just talked about. So now, imagine a kitchen fire causes $200,000 in damage. You'd think your $600,000 policy would cover it, right? Wrong. Because you were underinsured, your provider might only pay out $150,000, leaving you on the hook for a $50,000 bill. That's the 80% rule in action, and believe me, it is a costly mistake to make. So here's your game plan, your 3-step playbook. Step 1, start getting quotes the moment your offer is accepted. Step 2, lock in that policy early while you're still in escrow. And step 3, Confirm with your lender that they have everything they need way before your closing date. Do not let insurance be a last-minute scramble. But hey, what if you already own a home? Are you just stuck watching these costs spiral out of control? Well, not necessarily. There are some practical strategies you can use to try and manage those premiums. You do have some options. First, shop around aggressively. Use an independent broker who can check with lots of different carriers. You can also think about raising your deductible, which will lower your yearly premium. You can harden your home against fire with things like ember-resistant vents and clearing brush. And of course, the old classic, bundle your auto and home policies for a discount. And a final tip, try to avoid filing small claims because a claim-free history can really help you get better rates down the line. But let's be really clear about the future here. The hard reality is that most homeowners in Los Angeles should get ready to pay 30 to 50% more in the next couple of years than they did back in 2023. This is not a temporary blip. This is the new normal. So if there's one thing to take away from all this, it's this. Homeowners insurance is no longer just some small afterthought expense. You have to treat it like a core cost of ownership, right up there with your mortgage and your property taxes. It has to be in your budget from day one. And all of this leaves us with one final and pretty challenging question. As these massive costs become a permanent fixture of living here, you have to wonder, is your insurance premium just the new price of admission to Los Angeles?